Hey guys, Sean here. Let's talk about gold. Will the gold price ever recover? And more importantly, should you buy gold today? So if you're a gold investor, the price action of gold doesn't seem to make sense. Inflation's over 8%, the Russia-Ukraine war is escalating, and the situation between China and Taiwan is about to explode. But gold today is below 1700, down 6% year to date. Will it ever get a break? Now it seems that the conditions for gold should rocket its price up to at least 2 grand. But we are forgetting the real boogeyman in the room today, and that is rate hikes. We need to understand that right now, asset prices are controlled by what the central banks are gonna do. Money is gonna leave the system, and that is very bad news. In fact, there's gonna be more downside to go in everything. Stocks are gonna crash further, housing prices are gonna drop further, and precious metals are gonna experience another sell-off when rates start hiking again. So to explain what is going on, we need to boil things down to the basics and ask ourselves one central question. Do people even have money to invest and buy gold? Because all the analysis in the world will just come back to this one question, and we need to answer it today. But first, we need to understand time frames. The price of gold today is going to go down further. Gold will be under pressure for the next 3 to 6 months at the very least. But long term, the case for a raging bull market for gold is growing stronger with each passing week. We are seeing central banks start to accumulate gold month after month, and this is not going to stop. Every country today knows how risky it is to hold dollars. It's either going to be debased by money printing, or it could get frozen if America doesn't like you. But if you're waiting for that bull market in gold, checking your charts every single day, it's going to be some time away, guys. The whole world is in crisis mode right now. Everyone is in survival mode, trying to pay their bills and put food on the table. And the economy is contracting, and this situation is going to get worse down the line. Now, Powell's already warned us loud and clear in his Jackson Hole speech. He clearly said reducing inflation is likely to require a sustained period of below trend growth. Moreover, there will very likely be some softening of labor market conditions. I'll translate that for you. Powell is saying that the job market is going to take a beating and a lot of layoffs are coming. And when people lose their jobs, they have no money to invest or buy gold. And I think a lot of us still underestimate how bad the economy really is, and gold is experiencing a triple whammy that's putting a lid on the price. We are talking about rising rates, quantitative tightening, and a stronger dollar. All these are bad for gold. And once again, we need to remember the market, including gold, was on a non-stop rise. In fact, gold actually outperformed the entire stock market since 2000. Gold appreciated by 500%, while stocks only went up by 170%. And that's a huge difference, guys. But all this was fueled by easy money, cheap money. For over 20 years, we were living in a low interest rate environment near 0%. The Fed funds rate was declining, and this allowed a lot of people to borrow tons of money to speculate in every asset class known to man. We just need to look at house prices that went from $165,000 to over 440 grand in just 20 years. It's not a coincidence. But all this is reversing. The Fed is going to take money out of the economy, and like a house of cards, the markets are going to implode and gold is going to suffer as well. It is not a magical investment that is immune to tightening conditions. Now, when the stock market crashes, gold tends to be more resilient and could even gain in value. If we take a look at all the previous crashes, we can see gold actually comes out ahead with a 6.5% gain in price. However, we need to now compare the economy today to the stagflation crash of the early 1980s. We can see gold fell by 46%, which means if we take the much high of $2,000 gold, if history repeats itself, it could fall to around $1,100. Now, I don't think that's likely because the mining cost of gold is already around that level. The mining cost for big gold miners is around $1,200. If the price was to fall below that, supply and demand dynamics will force it back up. So let's talk about rising rates and QT. These are the main reasons why the price of gold can't go up. It's because when you raise interest rates, you are making it harder for people to borrow money, and whatever debt they have is getting more painful to repay. And when you do quantitative tightening, which is already going to take even more money out of the economy, you are going to jack rates up even further. Remember, quantitative tightening means money is either leaving or not going back into bonds. And we can see from this September onwards, the Fed is going to pull out $95 billion a month from treasuries and mortgage-backed securities. And this is very bad news for the whole economy. Lending rates for big companies are going to skyrocket, mortgage rates are going to go through the roof, and this means people have no money left to spend or invest. You can see how all these arguments come back to if people have spare cash or not. We shouldn't get tricked by charts like the personal consumption expenditure. It looks like people are spending more money and the economy is booming, but that's not possible. We are in a recession, 2 quarters of negative GDP growth. And it's because inflation is jacking up the prices of everything. People are paying more dollars for the same stuff. So as rate hikes and QT continues, we are going to see companies get squeezed. Unemployment will creep up and people will be spending much less money outside of food and gas. Asset prices are going to take a hit, including gold. Plus, it's not just the United States that's hiking rates. Every central bank now has no choice but hike rates. Higher interest rates are going to go global. The big problem with the US dollar is that it controls every other currency in the world. If the Fed hikes rates and other central banks don't, and they import tons of commodities and stuff, they'll face a currency crisis. Inflation will go through the roof. And we are seeing emerging markets like Sri Lanka, Turkey, and Egypt all burning through their dollar reserves. And this creates an artificial demand for the dollar. And guess what gold is priced in? US dollars. So you can see why gold just can't catch a break. The stronger dollar and rate hikes are clobbering gold to the ground. And there's still one big black swan event lurking out there. It is the incoming European winter. Now, if you didn't know by now, Europe has signed their own death warrant by imposing a Russian oil price cap. Russia has responded in kind by shutting off the Nord Stream 1 pipeline, denying the EU of their precious gas supply as winter approaches. And they are going to cut off oil to the west and sell it to Asia instead as well. So if Europe gets crushed and enters a recession, what does that mean? More people will have no money left to spend. Global trade will slow down and companies all over the world will get slapped and layoffs will skyrocket. And this is why the worst is not over yet, and I don't want to lie to you about the situation improving over the next 3 to 6 months. Those are the most dangerous period because things are still very bad out there. But we need to remember the situation will eventually improve, and we need to understand and be able to see the signs. We need to be able to identify when gold will be back on the rise. And that's the reason why I don't make 5 videos a week micro-analyzing every single move gold makes. I'm not in the business of reading tea leaves, trying to connect every obscure event to the price of gold. And I can tell you that 90% of the news out there is just noise. But there are some events that are undeniably bullish for gold. Now, the first is obvious. Gold will soar when Jerome Powell decides to print money and do another QE. Guys, we are now in the realm of QE infinity and the money printing is not going to stop. What we have now is an extended pause because of the insane inflation that's happening. And we can see back in 2008 and 2020, gold flew up and broke new highs after the Federal Reserve printed tons of money. The Fed increased their balance sheet from $900 billion to $9 trillion. That's a 10 times increase. So gold accounted for all this excess money supply and flew up in price. People knew dollars were getting debased, so they ran and they bought gold. And this is one scenario that I believe is very likely. Now, I don't have a crystal ball to tell you when it will come. It could be 6 months or 18 months down the road. But the Fed is going to tighten and raise rates until something breaks in the economy. And once that happens, they'll be forced to make a choice. Either they let the recession play out and millions of people start to lose their jobs, or they will lower rates and start printing money. So we need to watch the unemployment rate figures very carefully. Right now, we're at an all-time low in unemployment, and this is a lagging indicator, meaning when the rates go up, we are already in a recession, deep in a recession, and the economy is in big trouble. The unemployment rate is already creeping up, hitting 3.7% in August. And remember that the Fed watches this number because of their dual mandate. They are supposed to maintain price stability and maximum employment, and right now they are crushing demand to bring down prices, but that will cause higher unemployment. And if we see millions of job losses down the road, chances are the Fed will start printing money again. Now, for gold to take off, we also need a combination of low interest rates and low enough inflation. We need the economic conditions to be both favorable for companies and for people. Low interest rates allow companies to borrow money and grow, and that means more people will be employed and have more spending power, right? And lower inflation means that people will be able to cover their rent, their food, and gas bills. They have more breathing space to think about investing and buying gold. Remember, low inflation doesn't necessarily mean it's bad for gold. And as we have seen, too high an inflation rate can destroy investment demand across the board. So there has to be a middle ground. But what is the sweet spot for gold? Now, I can't give you a specific number because economic conditions always change, but I don't think we'll ever hit back to the norm of 2% inflation anymore. But gold has a tight correlation to the real yields of treasuries. Basically, when the real yields of treasuries goes up, that is bad for gold. Investors are getting a return on bonds that beat inflation, and when it is down, it is good for gold because investors are getting screwed with bonds. Now, this is a chart of gold versus inverted real yield, so you need to be looking at the black line in reverse. The lower it goes, it means bonds are performing well and the yield is becoming positive. The higher it goes, it means bond investors are losing and the yield is turning negative. And as we can see, since March this year, the Fed rate hikes have turned the real yields from negative to positive, and because of that, investors are selling off their gold and running into bonds. So what we want to see is for real yields to become more negative, and that will shift the momentum back in gold's favor. And for that to happen, we need interest rates to fall down faster than inflation. Both needs to go down, but interest rates needs to go down more. And we need people to have money in their pockets and still feel frustrated at inflation eating away at their purchasing power, and this will cause them to run to gold. Now, let's look at the long term. Interest rates and money printing are important, no doubt, but geopolitics is becoming an even bigger driver of gold going forward. Now, ever since the West has been sanctioning Russia to hell, especially freezing $300 billion worth of assets, the world is now afraid for their US dollar reserves. In fact, around 250 central banks keep over $3 trillion of their assets at the New York Fed, and that's half of the world's dollar reserves. It is insane. That is called extreme counterparty risk. And now, we have China aggressively dumping their US dollars while stacking more gold at the same time. We can see China offloading their treasuries for 7 straight months, especially after the US sanctioned away Russia's foreign assets in February. Right now, China's only holding $976 billion of US debt, and this is going to continue to fall. And guess what China is buying with those dollars? They are buying gold. They are draining it from every part of the world. We have China buying tons of gold from Switzerland and increasing their gold imports from Russia by 750%. And this is only going to accelerate for China. This is an existential crisis. Either they diversify out of dollars or risk all their money being frozen if the United States decides to just flick a switch. And the funny thing was that 5 years ago, Russia actually pulled their money out of the New York Fed because they were afraid of their reserves getting frozen. Well, it seems that fear was justified. And there's really no stopping this de-dollarization. So if you're buying gold, you need to think more long term. The world's biggest gold stackers, central banks, are going to reduce their counterparty risk in this multipolar world. And this means a new gold rush is going to happen sooner or later, which I believe will be once the Russia-Ukraine war ends and high inflation is crushed. So we got to understand that the price of gold is still under extreme short-term pressure. The combo of rising rates, quantitative tightening, and energy crisis in Europe is making things worse for gold. High inflation and high rates are making people broke and they only have money to buy food and pay rent. So you need to hang on for the ride, guys. And here's the thing, if you know the long-term picture for gold is good and you're buying on the way up, you should be happy the price is falling. But whatever you do, don't lump sum invest. the price of gold can very well fall another 10 or 20% over the next few months. However, the writing's on the wall, and we are moving into a future where globalization is breaking down. Countries are going to trust each other less and less, and when it comes to money, gold is the only option that makes sense. Zero counterparty risk, long-term store of value with the broadest base of use across the world. Because if gold was useless and a waste of space, why doesn't every central bank today sell all of their gold reserves for dollars? Something to think about. So let me know what you think in the comments below. Do you expect gold to fall in price more in the short term? Are you still a buyer today? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these insane times.